You found Michigan's retirement coach, Mike Douglas.
So a financial hot take has been circulating and really being echoed by the Motley Fool and a lot of analyst commentary. And here's the claim. The SpaceX IPO will leave retail investors holding the bag. This is really tied to the SpaceX IPO June 12th, the largest in history, raising $75 billion at a roughly $1.75 trillion valuation. There are real risks for retail investors, but saying that they'll automatically be left holding the bag, it's a little overly simplistic and sensational, but there's some truth. Let's break it down. Why does this claim exist and what's true about it? Number one, there is very extreme valuation risk. With something like SpaceX, it's a private company. It's got some unknown potential. It's coming public at about $1.75 trillion of valuation. That implies a 90 times plus their revenue, which means that what their revenue is today, 90 times that is its valuation. That's extremely high for any company of any kind. What's the translation of that? Investors aren't buying what SpaceX is today. They're buying what it might become. Think about AI, Starlink, really just the dominance of the space technology and infrastructure. That part of the claim is right. You are buying into the idea of what SpaceX will be. High valuation, it gives less margin for error, which means there's a really big downside risk if something comes up and all of a sudden Starlink stops being a company. Do I think it's going to happen? No. I do think that what you're buying is the aggregate of all of these technologies and the brilliance of Elon Musk as the potential of the company. You're also buying into the idea that there's not a lot of competition in this space. I'd say NASA is competition, but SpaceX is who had to go get the people back from the space station, right? So there is a real truth to the singularity of their field, but how much money is in the field? We don't know that. Number two, an IPO structure could favor insiders. Only about 4% of shares are being sold initially. That's pretty low. So insiders may begin selling after lockups expire. When an IPO happens, typically between 90 and 180 days is the holding term. Whoever buys right out of the gate has to hold their shares for 90 to 180 days. After that, you see a big drop off. People will sell their shares to take gains and they make a bunch of money. What happens to a stock when a bunch of people sell off the shares? They drop in value. That's why IPOs have what's called a pop and drop effect. They pop up on the initial buy and then they drop when the liquidation event happens. And as a result, more people can buy it at a lower price. And then the water finds its level. We find out what the real valuations are. So with a limited supply early, the price spikes. And then there's going to be this inside selling later, which is going to create price pressure. That's a very valid concern. This setup has historically led to early hype and a later pullback, the pop and drop. Number three, there is artificial demand right now. There's index inclusion, which means it can be added to index at a $1.75 trillion valuation and the amount of money they've raised. They are going to end up on the NASDAQ and on the S&P 500 and all that, which means they're going to be going into these funds and into every ETF and every growth fund that's out there. They're going to grab it. However, the rules have been adjusted, allowing faster inclusion into major indexes. It used to be you had to have a term of consistency, of financial reporting, of disclosures before you could get on these indexes. The rules have changed and now they can get on earlier. That forces index funds and 401ks to buy shares quickly. So some of the buying pressure may not be organic. It's mechanical, right? If you have a large cap fund that's investing in large companies, this is a $1.75 trillion company in theory. As a result, it's one of the biggest companies in the world and is going to have to go on these indexes. So this is a legitimate structural dynamic. It can create temporary inflated prices beyond fundamentals. If everybody buys it, it goes up. And then when the financials report, we'll see how it really lands. Number four, retail FOMO is huge. The fear of missing out on an IPO from SpaceX, that's a big issue. That's why so many phone calls have been coming in and everybody wants to be part of this thing. SpaceX is opening up to 30% of shares to retail investors, way above normal IPOs. IPOs historically pop about 19% on day one, which means that when you have retail demand, hype, Elon Musk, the opportunity, space as a general thing is always this dream thing. Every kid's had the space camp dream or thought. There's just massive FOMO on this. I want to be part of SpaceX. I want to be part of going to space and putting data centers up there, like all the stuff that they want to do. Everybody wants to be part of it. That's true. Retail often chases momentum all the way up at the top, but that's when the losses start to happen. We go chase it, it hits a number, and yet here comes the drop that we talked about. Where does the holding the bag argument go too far for retail investors? Well, number one, SpaceX is not a weak company. They have $18.7 billion in revenue in 2025 and growing fast. They are dominant in launches. Starlink global internet infrastructure is unmatched. There's nobody doing global internet like Starlink. This is not a meme stock. This isn't GameStop or AMC, where just a Reddit thread turned into a pop of money out of nowhere. This is a real category-defining business, and also one without a lot of competition. Remember, when you're in space, this isn't a grocery store. This isn't a technology company launching an AI company. It is SpaceX is its own category with that and very little competition. Number two, long-term versus short-term confusion. Critics often are talking about short-term IPO behavior. It is volatile. It's hype-driven. But investors should be asking, what does SpaceX look like in 5 to 10 years? The reality is many IPOs drop after listing. Some later become generational winners, but both can be true. Not all retail investors behave the same. There are traders chasing the day one pop, and then there's these long-term investors with discipline. The different outcome is going to be decided by who are you and what are you trying to pursue. Saying that retail will get burned ignores the fact that investor behaviors are different. If you buy early and you sell out, you win. If you believe SpaceX is a generational company that is going to be unique, generate money, and be on the forefront of technology from here on out, you should consider buying it. That's not a financial advice, but it is something you should think about. It's a long-term play. So if I'm a retail investor, and I think SpaceX and everything that Elon Musk touches has basically turned to gold in some form or fashion, buy it and hold it. I'm not saying buy it with 50% of your portfolio or 75%. Buy it with a little bit and just keep buying it as it goes up. But just, it's a good long-term decision for a lot of people. At the end of the day, what's true? The valuation is extremely aggressive. IPO mechanics can boost the price short-term, and retail hype increases the risk of buying high. But what's false? It's not guaranteed that retail loses. It's not fundamentally a bad company. Outcomes really depend on the timing and the strategy. I would say this: if you need money to pay your taxes in 6 months, don't put it in SpaceX hoping to make it all up. But if you're looking to buy a tech company that is extremely unique, it's run by one of the smartest people in history and has great growth opportunity, it's not bad to have it as part of your portfolio. Don't chase the opening hype. If you missed the IPO, you didn't miss the boat. All you did is you missed part of a roller coaster ride that you're not sure where you get off. Number two, watch the lockup expiring window. When people have to get out of the IPO, when they get to sell it, that's when the price drops. That's a great buying opportunity. You need to think about long-term or stay out. If you don't believe in the 5 to 10 year vision, I wouldn't play the IPO game. Again, I'm talking really towards people who are closer towards retirement. If you're 30 years old and you want to jump in on the IPO, do it. Take your lumps, learn your lessons, maybe make a bunch of money. Just be aware of the risks. And number four, consider a more indirect exposure. You may already own SpaceX soon just by having your index funds. So don't think that you have to go out there, open an E-Trade account or a Robinhood account and go buy a bunch of SpaceX. You're going to end up with it in your index funds. It's not a matter of if it goes on the indexes. It's happening sooner than later. So you will be part of the SpaceX push. You can determine the amount of exposure you dial in for yourself. This isn't automatically a retail investor trap. But if you're buying the hype instead of the numbers, then you might end up holding the bag. If you have questions about how to balance your portfolio for retirement, you can reach out to us on our website, michigansretirementcoach.com, or click on the links we have listed here below to have more conversations about SpaceX, IPOs, and how to invest in retirement.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit michigansretirementcoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.